Hey, it's Mike Carpenter, frequently and sometimes affectionately known as Mike the Money Man. I'm a mortgage broker in the state of Washington, and my license number is 111356. So in this section, we're going to talk about mortgage insurance, or PMI or MI, the dreaded mortgage insurance. There's a lot of myths associated with mortgage insurance, so I'll try to dispel as many as I can. We're going to talk about conventional loans, FHA loans, and VA loans, and how the mortgage insurance works for each of those. We're going to talk about why mortgage insurance may or may not apply to jumbo loans. And we're going to talk about mortgage insurance before the mortgage crisis and mortgage insurance after the mortgage crisis. And we may also touch upon what's known as compensating factors, which may increase your mortgage insurance or decrease your mortgage insurance depending upon your specific situation. So up to this point, we've spoken about mortgage insurance as it relates to VA loans and FHA loans. We're going to cover how it applies to conventional or conforming loans. And we had mentioned that the VA loan has one part mortgage insurance, and that is in the form of a VA funding fee. And on a first-time purchase, it's 2.15% of the loan amount added to the loan. And we had talked about FHA mortgage insurance, and we talked about, and we noted that it's two-part, monthly, or 0.85% of the loan amount, divided by 10, divided by 12 to get the monthly part. And the upfront mortgage insurance was 1.75% of the loan amount. So an FHA has two-part mortgage insurance. But conventional and conforming loans have a one part. So this is upfront. This is monthly and upfront. And this is only monthly. And it's one part mortgage insurance. So somewhere in the past, and we're not going to cover things like refundable or refundable mortgage insurance, or something called split edge mortgage insurance, whatever that is. And we're not going to talk about lender paid mortgage insurance. If you want to know about these, email me. I'll tell you all about it. But so back in the midst of mortgage history, they figured out that 20% down is sort of the threshold for mortgage insurance. So if you put greater than or equal to 20% down, there's no mortgage insurance, no MI. And if you put less than 20% down, there is MI. So if you're putting more than 20%, this is 20%, there's no MI. And if you put greater than 20%, or excuse me, less than 20% down, there is mortgage insurance. So to understand mortgage insurance, you have to understand effectively how this system works. So there's what I call the old or sliding scale and something called the new merit-based system. And if you look up merit-based system mortgage insurance, you're never going to find anything. Or if you look up old sliding scale mortgage insurance, you're never going to find anything. Those are terms that I made up just so I can understand it and explain it to you. So let me sort of give you a quick rundown of what the sliding scale looks like. So from 80.01 to 85, there's one mortgage insurance factor, and that is 0.19 of the loan amount divided by 10 divided by 12 to get your monthly amount. So the 0.19 is monthly. What the total monthly or is yearly. So what the total yearly amount is. And then from 85.01 to 90, it is 0.28% of the loan amount divided by 10 divided by 12. And from 90.01 to 95, it is 0.38%. And then from 95.01 to 97, it's 0.58. And the way you calculate this, so essentially, the more you put down, the less your monthly mortgage insurance will be. The less you put down, the more your monthly mortgage insurance will be, which makes sense. But in order to calculate this, you simply take, say, a loan amount of $400,000 times 0.38, let's say, divided by 10, divided by 12. So we come up with a yearly amount of $1,520 divided by 12, which is 126 and 67 cents per month. That's how you calculate it. But on top of that, they now layer something called what I call a merit-based system, and that essentially takes into consideration the following elements: credit score, debt to income ratio, and we've done a complete section on debt to income ratio previously. Loan term, whether it's 15 years or 20 years or 30 years. Property type, whether it is a condo or a single-family residence. And we're doing an entire section on condos versus single-family residences. Number of borrowers. And occupancy. Whether the property is a primary residence or if it is what they call a second home. Now, remember, a second home is not an investment property that you've purchased. A second home is something that you occupied just like a primary residence, but not the full time of the year. Like a property that's near a amenity like a ski resort or a lake or something of that nature. So let's run through these really quickly. The ideal borrower has, say, a 780 credit score. So if you've got, say, a 620 credit score versus, say, a 790 credit score, your mortgage insurance factor may be worse than the factors that we've got here. Debt to income ratio. So they like 45% as a max, but the higher your debt to income ratio, the worse your mortgage insurance factor may be, or the lower your debt to income ratio, the better your mortgage insurance may be. And whether or not it's 15, 20, or 30-year fixed, whether it is a condo or single family residence, whether you have one borrower or two borrowers or three borrowers, I guess the logic being that if there's a second borrower, your mortgage insurance factor may be less than if you have one borrower, because I presume there's one more borrower left over to make the payment, and whether or not it's a primary residence or if it's a second home. So all of these items may stack up in your favor, and you may get a better mortgage insurance factor than what the sliding scale provides. Or you could get a worse mortgage insurance factor than what the sliding scale provides, assuming that these things stack in your against you. So there's a website that I often use called Radian Rate Finder. And there's all kinds of mortgage insurance companies, but Radian Rate Finder, Radian rate finder. If you Google it, you'll find it, and you can put in all of these variables to your heart's content, and it will kick out a mortgage insurance factor estimate for your scenario. So if you really want to geek out and know what your mortgage insurance factor is, you can calculate it to your heart's content and play with the variables and have fun. Now, also, depending upon the lender that you work with, some have they I guess bundle their loans together and they send them all to one mortgage insurance company, and they get a much more favorable rate depending upon which lender you use than whatever this provides. But if you want to email me, I am happy to send you a link to Radian Rate Finder, and you can have fun calculating your mortgage insurance, and you can tell all your friends about it. I hope you found this useful. Let me know if you have good questions. I'm happy to help answer any questions that you have. Thanks for watching my video. I hope you found it useful and informative. It's intended as a broad overview of the material so that you may have some further questions. Feel free to ask them, and I'll be happy to answer them as best I can. Share, like, and subscribe, but share it with somebody who can actually use it. Maybe someone who's going through the loan process and is a little confused. Hope they get something out of it as well. So happy viewing. There's more to the series. Hope you enjoy the rest of the videos. Thank you. And now for a quick disclaimer. So these videos are intended for informational purposes only. So don't rely on them for making important financial decisions, especially decisions concerning your housing. If you've got any questions about how this information applies to your given situation or your given transaction, please contact your mortgage broker directly, and they can give you advice. And any rate, fee, cost, or loan limit information was accurate at the time that the video was made, but may not be currently accurate because underwriting guidelines change all the time. So if you've got any questions about how this information relates to you specifically, contact your mortgage broker. So I hope you continue to enjoy the series. Thanks.